Good evening and welcome to the Money Show, your one-stop destination for everything money, markets and making smart financial choices. I'm Kavitha Thapliyal. In a world full of economic uncertainty and ever-changing investment options, this is the space where we break down the noise and help you take control of your finances. A one informed decision at a time. Whether you are looking to grow your wealth, plan for retirement, save your child's future, or simply understand where is money going, we've got you covered. From mutual funds to market trends, insurance to income tax hacks. This show is built around your financial questions and real life money goals. So all you have to do is just stay with us, because we will decode everything about your personal finance. We'll get expert insights, bring you actionable strategies that make your money work harder for you, because you're on the Money Show. Your money matters. In this show, we also answer or give you strategy for each of your financial goals, just in case you want to be our live viewer on the show. Talk to our experts, get the recommendations. All you have to do is just send across your questions on our WhatsApp number and our email ID, which will be flashing on the screen. 865-797-4571 is our WhatsApp number, and the email ID is themoneyshow@etnow.tv. All right, so let's begin the show with a very special initiative. The beginning of the month often marks key financial activities like salary, credits, bill payments, and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments. To encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. Now, as a part of this campaign, we are observing 4th of every month as a monthly reminder to ensure that you start your mutual fund SIP, or ensure your existing SIP continues. So go on and set your reminder to invest consistently and stay committed to your goals for the financial well-being of you and your loved ones. And today, on this very special segment, we'll be talking about your return expectation. Now, obviously, if you are having an investment strategy, you have aligned it with the specific financial goals, taking a specific amount of return expectation under consideration. What kind of return expectation you'll be having should from your investments across asset classes, and also we'll be exploring a bit about hybrid category or hybrid way of investments. I have with me Gaurav Dharmaraha, National Head, Retail Distribution Alliances, SBI Mutual Fund. Gaurav, hi, good evening, and welcome to the show. Let's first talk about market volatility, because that is something that's being a pain for a lot of investors. So I know I'm not talking about short term, but then, even the long-term investors do get worried when these kind of short-term blips happen to come. So markets are going through a volatile phase. What are the key signals that investors should be watching closely right now, according to you?
First of all, thank you, Kavitha, for having me on this show. As you rightly said, uh, over the last few weeks, few months, we have seen a lot of volatility in the market, thanks to a lot of geopolitical situations earlier. Then the US Trump tariff policies, which have been kind of disturbing the markets in and out in the recent few weeks. Yes, as you rightly mentioned, what we saw over the last 4 to 5 years, the markets delivered much beyond the expectations of the majority. And now going forward, looking at the volatility that is happening in the market, we have to kind of taper down our returns, taper down our expectations, while ensuring that the basic principles of investing, goal-based investing rather, things like asset allocation should always remain at par. Frankly, we look at that what you got over the last 4 to 5 years, high double-digit returns should ideally be tapered down to somewhere around lower double-digit over a period of next 3 to 5 years. While we emphasize the returns should not be the only defining factor, your focus, your discipline, as I earlier said, on asset allocation, which would define achieving your goal-based objectives of coming to the capital markets, that discipline should be maintained at any given point of time.
All right, Gaurav, let's just focus the conversation slightly on the return expectation. Now, while long-term portfolios may not need immediate restructuring, as you already said that you need to be well diversified so that, but in every volatile phase, there is a different way an asset class reacts and you get the benefit of that, in fact. So, no need of immediate restructuring as far as your portfolio is concerned. But then, is this a time when investors should adjust their return expectation? If yes, how can one do it and across what categories of investment avenues we talking about?
See, as I mentioned, that definitely you need to look at the tapered down returns. So the rear view mirror performance review that we generally look at should not be seen as the true reflection of the next 3 to 5 years. So that clearly indicates that what you saw happening over returns over the last 4 or 5 years may not or definitely not replicate over the next 4 to 5 years. You should definitely look to move, change your asset classes. You have choice of hybrid funds where you can switch between equity, debt, arbitrage, to some extent, precious metals. This is a collective collaboration grouping of various asset classes, which is represented through various hybrid funds. Also, on the market caps, you can look to move your funds from the mid cap and small cap strategies towards large caps. Uh, Past, the returns were driven highly by the liquidity piece. Future, we see that the returns will be driven by earnings growth. There will be limited stocks that will be offering you that kind of earnings growth. So on the market caps, ideally you should be more large cap tilted, and you should definitely go for a greater exposure in various hybrid strategies. Hybrids come across a major shock absorber in especially these volatile markets, and also ensure that the right grouping of the various asset classes like equity, debt, and arbitrage ensures very cost-effective, tax-efficient returns, and FD plus plus kind of a returns over the next 3 to 5 years.
All right. Now, in the face of short-term uncertainty, Gaurav, what are some practical risk management strategies that investors can adopt without, derailing their long-term goals? Because we often talk about revamping and reshuffling around your portfolio, in terms of asset classes, and even within equity, if one needs to really reshuffle. So, is that the kind of strategy you are looking at because of short-term uncertainty and volatility that one should be adopting? Or according to you, the practical way to manage risk is to just stay put? Should one be doing that?
So if you have monies for very short term, say 3 to 6 months, then ideally arbitrage funds gives you a rightmost solution, because they not only are able to deliver returns better than your normal orthodox banking products, but they are highly tax efficient also. On the long term, some strategic shift that I suggested, that you can tilt towards large caps, you can have a greater exposure towards hybrids. Now, within hybrids also, you have conservative hybrid strategies, which take an exposure of only about 20% on equities, and balance 80% remains on the debt side. Going up the curve, you can have the balance advantage funds and the multi-asset allocation funds, whereas balance advantage fund would primarily between equity, debt, and arbitrage. Multi-asset, along with equity and debt, would have an exposure towards precious metals like gold and silver. These are also very, very tax efficient products, because as you are aware that equity taxation more than 1 year stands only at about 12.5%. Most of these funds play equity with arbitrage collectively for more than 60.
Okay, I think there is some technical issue with Gaurav's feed out there. But then, having said that, the right time to balance out your portfolio is now. And as Gaurav also was explaining, it's time to taper down your expectation. I think we have him back again. Gaurav, yeah, you can continue.
So yes, as I mentioned that within hybrid schemes, you can move between conservative hybrid, which is on the lower side of equity and high side of debt, to a mix of balance advantage funds and multi-asset allocation funds. which most of these funds gives you a high tax efficiency owing to the mix of equity and arbitrage greater than 65%. And few of the multi-asset allocation funds also gives you a great exposure on precious metals. And on the aggressive side of hybrids, you can definitely look at equity hybrid funds where the equity exposure can range between 75 to 80%. Thus, hybrids in totality gives a lot more cushion to volatile markets, becomes a shock absorber, gives you reasonably FD plus plus kind of a return, and ensures a much smoother experience for not only the older set of customers who are there and present in the capital markets, but also to the newer set of customers who have joined the capital markets in the recent a few months or few years. So that is the strategy that you need to definitely look and focus for the next 2 to 3 years, along with the tilt on large cap
All right.
strategies.
All right, Gaurav. So hybrid is the way to go, especially if you're looking at practical risk management strategies to deal with the volatility in the market. So conservative, balanced, aggressive, dynamic, whatever is your risk profile, you have it all in this category. And with that, it's time up for this segment on the show also, Gaurav. But thank you so much for taking time out and guiding our investors, for how to deal with volatility in the current market situation. Thank you. But we move on and time for a quick break. Post that, I'll be joined by Hemant Susigi, who is the financial planner for you today. And in case you want to send across your questions, quickly note down our WhatsApp number and email ID where you can send across your portfolio details. And we will help you align your investments with each of your financial goals after this break.